Investing in startups and angel investing. Angel investing offers a thrilling opportunity to support innovative startups at their earliest stages while potentially earning substantial returns. Unlike traditional investments, angel investors provide not only capital but also mentorship and industry expertise to help young companies grow. However, this high-risk, high-reward avenue requires careful evaluation, a strong understanding of legal and financial complexities, and a well-planned strategy. This guide explores everything aspiring angels need to know to navigate this dynamic investment landscape effectively. Introduction to angel investing. What it means to invest in startups. Angel investing involves providing capital to early-stage startups in exchange for equity ownership or convertible debt. Unlike venture capitalists who manage pooled funds, angel investors typically invest their own money, often at the very beginning of a company's life cycle. This form of investing is high risk but also offers potentially high rewards if the startup succeeds. Angels not only provide funds but often bring expertise, mentorship, and valuable networks to help startups grow. How to evaluate startups for angel investment? Evaluating startups requires a careful analysis beyond just the financials. Angel investors scrutinize the founding team's experience, vision, and commitment, since founders drive early success. Market opportunity is critical. Investors seek startups addressing large or rapidly growing markets with scalable business models. Product or service differentiation and competitive advantages are key factors. Additionally, investors assess traction metrics such as user growth, revenue, or partnerships. Due diligence includes reviewing legal aspects, intellectual property, and financial projections. Understanding the risks and rewards of angel investing. Angel investing is inherently risky due to high failure rates among startups, illiquidity of investments, and long time horizons before potential exits. Most startups fail or deliver modest returns, meaning angels must expect to lose money on some investments. However, successful investments in startups with exponential growth can yield substantial returns, sometimes multiples of the original investment. Diversification across several startups helps manage risk. Patience is necessary, as exits may take years via acquisitions or IPOs. The role of angel investors beyond capital. Angel investors often play an active role beyond funding by offering mentorship, industry connections, and strategic guidance. Many startups benefit from angels' expertise in product development, marketing, fundraising, and business operations. This hands-on involvement can increase the likelihood of startup success and protect the investor's capital. Angels also help startups navigate challenges such as scaling, hiring, or regulatory compliance. This value-added approach differentiates angel investing from passive investments and makes it attractive for individuals who want to contribute meaningfully to innovation while seeking financial returns. How to find angel investing opportunities. Accessing quality startup deals requires networking within the startup ecosystem. Angel investors find opportunities through incubators, accelerators, pitch events, online platforms, and angel groups or syndicates. Building relationships with entrepreneurs, venture capitalists, and fellow angels expands deal flow. Many investors use platforms like AngelList or Seed Invest to co-invest with experienced angels. Attending industry conferences or local meetups also helps discover startups aligned with an investor's interests. Structuring angel investments, equity, convertible notes, and safe agreements. Angel investments can be structured in several ways. Direct equity investments provide immediate ownership but require valuation agreement upfront, which can be challenging for early-stage startups. Convertible notes are debt instruments that convert into equity during future financing rounds, postponing valuation discussions. Safe or simple agreement for future equity are similar but more investor-friendly and straightforward. Understanding these instruments, their implications on ownership, control, and exit scenarios is crucial. Legal and tax considerations for angel investors. Angel investing involves complex legal and tax issues. Investors should conduct thorough due diligence, including reviewing shareholder agreements, intellectual property rights, and compliance with securities laws. Many jurisdictions require accreditation or financial suitability for angel investors due to high risks. Tax considerations include potential deductions, capital gains treatment, and tax-advantaged accounts like opportunity zones or Section 1202 qualified small business stock exemptions in the U.S. Consulting legal and tax professionals ensures compliance and optimizes investment outcomes. Diversification strategies in angel investing. Due to the high-risk nature of startup investing, diversification is a critical risk management strategy. Angels typically spread their capital across multiple startups and industries to increase the chances of success. Diversification reduces exposure to any single company's failure and captures growth across sectors. While this requires substantial capital to be effective, joining angel groups or syndicates allows smaller investors to pool resources and co-invest. Monitoring and periodically rebalancing investments based on performance and market conditions further improves portfolio resilience. Exit strategies. How angel investors realize returns. Angel investors realize returns primarily through exit events such as acquisitions, initial public offerings, or secondary sales. These exits can take several years, often 5 to 10 or more, requiring patience and long-term commitment. Some startups fail to provide liquidity, emphasizing the importance of choosing startups with viable exit paths. Secondary markets for private shares are emerging but remain limited. Exit negotiations, tax implications, and timing are critical considerations. Building your angel investing portfolio. Tips for beginners. For those new to angel investing, starting with education and networking is vital. Learning from experienced investors, attend workshops, and study case studies of successful and failed investments. Begin with smaller investments in startups you understand well and gradually diversify. Use angel networks to gain access to curated deals and syndication opportunities. Set clear investment criteria based on risk tolerance, sectors of interest, and desired involvement. Maintain realistic expectations, track your portfolio, and learn from outcomes. Angel investing is as much about passion and belief in innovation as it is about financial gain. Success in this field depends on diligent startup evaluation, active involvement, strategic diversification, and patience through long investment horizons. While risks are significant, the potential to foster groundbreaking businesses and reap outsized rewards makes angel investing a unique and rewarding journey. With education, networking, and thoughtful planning, you can build a robust angel portfolio that aligns with your goals and appetite for risk.